Between 1980 and 2000, gold lost nearly 70% of its real value, 2 entire decades. While the stock market multiplied several times over, gold quietly bled out. Not in a single crash, not because of a war, just slowly, silently, over 20 years of doing absolutely nothing. That is the story nobody tells you when they show you a gold bar and call it safety. So let us talk about what gold actually is, how it actually behaves, and whether it deserves the place it holds in most Indian households. First, you need to understand why gold feels safe. This is not irrational. The feeling has deep roots. It cannot be printed. It cannot be created by a government that runs out of ideas. Stock requires a company to perform. A bond requires a borrower to repay. Gold requires nothing from anyone. It simply sits there, being gold. That is genuinely valuable. That is not a myth. But here is where the story gets complicated. Gold is not an investment in the traditional sense. It does not produce anything. It does not earn revenue. It does not pay dividends. When you hold gold, you are not owning a piece of a business that is working every day to grow your wealth. You are holding a store of value that simply reflects what people collectively believe it is worth. That distinction matters enormously. Consider what happens when you invest in a well run company. That company has employees working every day. It is acquiring customers. It is generating revenue. It is innovating. Even while you sleep, the business is compounding value. Economist John Maynard Keynes called gold a barbarous relic precisely because it lacks this productive capacity. You can argue with that framing. But the underlying point is hard to dismiss. Gold does not work, it waits. Now, let us talk about inflation. Gold is almost universally pitched as an inflation hedge. The idea is simple. When the rupee loses value, gold holds its purchasing power. And historically, over very long time horizons, this is roughly true. A gram of gold in ancient Rome could buy a fine toga. A gram of gold today can buy a fine business outfit. Across millennia, the purchasing power has held. But you are not investing across millennia. You are investing across decades. And over human investment horizons, gold is a shockingly unreliable inflation hedge. Finance researcher Claude Erb and Duke University professor Campbell Harvey published a detailed study in 2013 examining gold's inflation hedging properties. Their finding was striking. Gold does an excellent job of preserving purchasing power over centuries, but over periods of 10, 20, or even 30 years, the relationship between gold prices and inflation is extremely weak. Gold can massively overshoot inflation during periods of fear and massively undershoot during periods of calm. In other words, gold hedges inflation on a timescale that is longer than most human lives. For the investment horizon you actually have, it is far less reliable than it seems. So, when does gold actually go up? The answer is fear. Gold does not respond to economic growth, it responds to economic uncertainty. When investors are scared, when currencies look fragile, when geopolitical tensions rise, when stock markets are crashing, gold surges. When confidence returns, gold stagnates. Behavioral economist Robert Shiller, who won the Nobel Prize in Economics, has written extensively about how investor sentiment drives gold prices far more than fundamentals do. Gold, he argues, is one of the clearest examples of a narrative driven asset. It goes up because people believe it will go up in a crisis. And that belief becomes self fulfilling. Economies grow, companies expand, and gold quietly sits in someone's locker earning exactly zero. Let us look at what this actually means for an Indian investor. Imagine two people in 2003. One invests 1 lakh rupees in physical gold, the other invests the same amount in an index fund tracking the Sensex. Both of them hold for 20 years. The gold buyer does reasonably well. Gold has had a strong 2 decade run in India, partly driven by a global commodities bull run and partly driven by rupee depreciation. Their 1 lakh grows. But the index fund investor, they experience crashes in 2008, volatility in 2011, a brutal 2020. They probably feel worse at several points during the journey. But over 20 years, the compounding of corporate earnings, dividends, and economic growth produces a number that is substantially larger. And that is during a period that was unusually kind to gold. Now, add one more factor that most people completely ignore: the cost of holding gold in India. If you are holding physical gold, you paid making charges when you bought it, anywhere between 8 and 35% of the value, depending on the jeweler, depending on the design. That is money you have already lost on day one. You also face wealth tax considerations, storage costs if you use a bank locker, and the risk of theft. And when you eventually sell, you pay capital gains tax, plus the buyer deducts for any perceived impurity. Sovereign gold bonds solve some of these problems. They give you a small interest rate, eliminate storage costs, and provide a more transparent pricing mechanism, but they are illiquid for years. And your return is still ultimately tied to an asset that does not produce anything. Gold ETFs offer better liquidity, but they come with expense ratios and still carry the fundamental limitation of gold itself. You are still just holding an asset that waits. None of this means you should own zero gold. That is not the conclusion. Gold has a genuine role in a diversified portfolio. Legendary investor Ray Dalio has built parts of his all weather portfolio around gold precisely because of its negative correlation with equities during crisis. When everything else falls, gold tends to hold or rise. For Indian households specifically, gold also carries cultural and emotional weight. Weddings, ceremonies, and generational wealth transfer often involve gold, and that is a legitimate function. The question is not whether to own gold, the question is how much and why. Financial planner and researcher William Bernstein suggests that most investors should hold 5 to 10% of their portfolio in gold as a crisis hedge, not as a core wealth building vehicle. That framing is the key insight. Gold is a hedge, it is insurance. It is the part of your portfolio that gives you stability when everything else is burning. It is not the engine. It cannot be the engine. The mistake most Indian investors make is the reverse. They hold 60, 70, sometimes 80% of their family wealth in gold. They call it safe. They call it an investment. They pass it to the next generation as a sign of financial wisdom. But what they have actually built is a portfolio that does nothing 90% of the time, charges them heavily when they enter and exit, and only proves its worth in the rare moments of genuine systemic crisis. Here is a simple way to reframe your thinking about gold. Ask yourself what you want this asset to do for you. If the answer is to protect you in the worst case scenario, gold is a reasonable choice for a portion of your money. If the answer is to grow your wealth over 15 or 20 years so you can retire comfortably, gold is one of the worst tools available to you. Not because gold is bad, because gold is doing a job it was never designed to do. A fire extinguisher is a brilliant piece of equipment. You should absolutely own one, but you would not use it to water your garden every day. It is built for a specific emergency. So is gold. The investors who build real wealth over decades are not the ones who hold the most gold. They are the ones who understand the difference between assets that store value and assets that create value. They hold enough gold to sleep at night when markets crash. And they hold enough equities to actually build something while the world is not ending, which is most of the time. 5,000 years ago, humans decided gold was worth trusting. And for 5,000 years of surviving chaos, that instinct has not been wrong. But surviving and thriving are two different things. And if you want to do more than survive, you need to own assets that do more than wait. Gold has earned its place in history. The question is whether it has earned the place it holds in your portfolio. Like, share, and subscribe to Invest Thar for more insightful videos like this.